In response to requests from the propane industry and other stakeholders, EIA added 2 new measures of supply adequacy to its weekly propane market update, which is updated weekly during the heating season. This runs from the first week in October to the last week in March. This deck is in addition to price and stocks information published on EIA's winter heating fuels page, which is also updated weekly. EIA continues to publish all weekly propane supply estimates, including production, stocks, imports, exports, and products supplied throughout the year. We're going to have 2 presentations, and then we will move to the Q&A session. Rob Merriam, Director of the Office of Petroleum and Biofuel Statistics, will explain the 2 additional measures added in November of 2017. He'll give you a detailed introduction. Warren Vilchevsky, EIA's propane expert, will discuss the current market situation and he'll be one of the key responders to any questions that you might have. So at this point, I'm going to turn it over to Rob Merriam, and then we'll immediately, after Rob's presentation, we'll have Warren speak, and then we'll open it up.
Okay, thanks, Shirley. So this is Rob Merriam. Before I go into describing the 3 different measures of supply adequacy that EIA is now making available for our stakeholders, I think it would be helpful to first define a couple of terms that we use that are important to better understanding those measures. The first term is product supplied. EIA uses this term, product supplied, as a proxy for what most of our readers consider to be consumption of a product, in this case propane. That's because EIA's petroleum surveys collect our weekly and our monthly data from companies that are part of the primary supply chain level, which is essentially akin to the wholesale level or the primary level where products are first made available to the market. We're not collecting data from the secondary suppliers or propane distributors or dealers or even consumers, but rather EIA surveys are filed by refineries and natural gas processing plants that produce propane and firms that import large amounts of propane into the U.S., all of whom then store this propane initially at large bulk terminals and in underground caverns, each capable of holding at least 50,000 barrels or more of inventory. That's the primary supply chain level, and that's the level at which EIA conducts our surveys. In short, we're measuring how much propane is supplied by leaving and what leaves the primary market level. Keep in mind, and this is an important point, these primary suppliers support the secondary storage supply chain, which includes smaller bulk plants and propane distributors who draw their supplies from these larger bulk terminals to support their own customers. So when EIA's primary level inventory data shows that inventories may have dropped over the week, let's say, like it did this week, for example, that likely means that these secondary suppliers have taken the product to meet their customer commitments, or perhaps some product is left as an export out of the U.S., or in many cases, both. For those of you interested in the actual data elements that EIA surveys are used to derive product supply for propane, it's simply the combination of propane production from both natural gas processing plants and refineries, plus propane imported into the U.S., minus the weekly change in propane inventories at the primary or bulk terminal level, minus any propane exports that EIA estimates based on U.S. Customs and Border Protection data that agency shares with us. Okay, so that's product supplied and primary inventory. Those are important points to keep in mind. The last 2 terms to understand for today's discussion are days of supply and days of disposition, which I'll get to next. Days of supply is the conventional term that EIA has used for many years and that we continue to use for all of our products, including propane. It's simply a relative measure of current inventory, in this case propane inventory, compared to the latest 4-week average levels of domestic consumption of propane, i.e. propane product supplied. So it's inventory divided by a 4-week average product supply to get a relative sense of how those current inventories relate to current customer demand for propane. Note, however, that the concept of days of supply is sort of a worst-case scenario in that it assumes that all other supplies of propane are cut off. For example, not a single barrel of propane is produced by refineries or natural gas processing plants, and not one barrel is imported into the U.S. And so the only source of supply to meet customer needs is from our current level of inventory. Further, it also assumes that despite all new sources of propane being cut off, consumption and then prices of propane would continue at current levels, completely unabated by this drastic, hypothetical, we hope, market impact. In that sense, it's an extreme scenario. We only have the inventory on hand to sustain us, and the days of supply measure tells us at current unabated consumption levels how many days we could go. So a key takeaway here is not to take any of these days of supply alternatives as a literal measure of supply adequacy, but rather, as I said earlier, use it as most analysts in the energy community do, to get a relative sense of how current inventory levels compare to current demands for propane. If we go to the next slide, we can see what this days of supply looks like over time, going back to 2010. So you can see in this chart how days of supply follows a very clear seasonal pattern, since its primary use in the United States is as a heating fuel in certain regions of the country. And that clear pattern is this. During the spring and summer, propane inventories build while consumption of it is relatively low, which gives us pretty high days of supply during those seasons. As the weather turns colder, inventories are drawn down as consumption increases, giving us relatively lower days of supply for those months. By this measure, you can see also that since 2015, the days of supply have ranged roughly between 40 days to 100 or 120 or so days. And if you look closely, you can see that currently, for late December, which is the last date this chart goes through, we're right about where we usually are in terms of this measure. Again, this should not be used as a literal measure of how long our inventory will last, but as a relative measure of how inventories compare to recent average domestic consumption. Slide 6. Next slide. Now, as the production of propane in this country has risen dramatically in recent years, due mostly to advances in U.S. natural gas and oil production, U.S. propane production has started far outstripping domestic demand needs. As a result, U.S. exports of propane have also risen pretty dramatically in recent years to become an important outlet for this new production. Also as a result, our stakeholders at the NPGA asked if EIA would provide an alternative measure of days of supply that also factored in average export levels. And that's what this yellow line chart shows, which we call days of disposition. This measure begins just like the prior chart, the green line that we just had up there for days of supply, but it compares those same inventories not only to current average consumption, but also includes current average export levels as well, to see how many days those same inventories will last. Again, assuming all production imports of propane were to cease. Not surprisingly, it's less. This just refers to the fact that under this alternative supply measure, which again assumes that all supply sources are cut off going forward and we only have inventories to supply the market, we now assume that both recent domestic consumption and recent average exports of propane would both continue completely unabated. Again, a hypothetical extreme case scenario that I hope people understand is unlikely to play out this way, as we'd expect some price impacts to occur, which would alter both consumer demand and propane and price incentives to export it overseas. However, even using this alternate measure, just like EIA's conventional days of supply measure, you can still see very clear seasonal patterns that range from about 20 to about 60 or so days of inventory disposition, and also that our current level for late December using this measure is, once again, on par with where we typically are this time of year. EIA has also added one other alternate measure of days of supply, shown here by the red line in slide 7, called days of supply under severe weather. This measure, like the others, starts with current inventories, but compares them relative to the average of the 5 highest weeks of product supplied for the last 5 years. It's essentially saying, if we took the average propane consumption for the 5 coldest weeks over the last 5 years and had no new supplies being produced or imported, how long would current inventory last us? Again, another worst-case scenario. No new supplies and assuming the coldest of the cold weather to deal with, even in July and August. But using this measure, the chart again tells us that depending on the season, the days of supply, assuming the most severe weather, still range from between 20 to 50 or so days. It still shows clear seasonal patterns, and it shows us currently we're right about where we typically are for this time of year. So what's the takeaway here? It's this. At the request of the NPGA stakeholders, EIA has made some alternative measures of supply adequacy available to our readers, who can now use whichever measure seems to make the most sense for their analysis, to gauge propane markets, to plan their supply strategies, etc. But because these measures each make different assumptions about what is driving those propane inventories to be drawn down, you cannot compare one measure to another to conclude that we now have more or less days of supply left than another measure. This means one should not compare the yellow line to the green line for December 2017, for example, to conclude that propane inventories will last us half as long as we initially thought. Rather, one can and should look at any of these lines historically to see how that particular measure compares now to any point in its past, and only compare it relative to itself. So for example, I think this chart shows pretty clearly that our current level of inventory, which is the same for all 3 measures at roughly somewhere between 60 and 65 million barrels nationally as of late December, would last us, under each hypothetical scenario, about the same number of days as each line has assumed historically for this time of year. So that completes my discussion of the days of supply alternate measures that we are putting out there. I'm now going to turn it over, the discussion and the slides, to my colleague Warren Wilczewski, who's going to provide a brief summary of the current propane market.
Thank you, Rob. Thank you to all who've dialed into our webinar today. And my apologies to those on the East Coast for cutting into your lunch hour. Hopefully you're finding this discussion useful. Rather than talking about current stocks and prices, which are covered in depth in our weekly propane market update, I'd like to zoom out a bit and look at the propane market from a longer-term perspective. By the way, this week's release of the weekly propane market update is going live on our website at 1 p.m. today. So just before the Q&A or just during the Q&A. So looking at just the 2010 to 2017 time frame, we can see how propane delivered into the domestic market, EIA's propane supplied measure, has declined steadily, with the exception of 2013 and 14, when high demand for grain drying and heating, as well as elevated use of propane as a petrochemical feedstock, increased product supplied above the trend line. 2016 propane product supplied came in 2% below 2010, and early indicators for 2017 suggest the year will end even lower. This decrease can be attributed to a number of factors. Homes in general are becoming more efficient, and new standards for water heaters and furnaces are reducing consumption. The American Community Survey also reports that over this period, the number of households using propane as a primary heating fuel has declined by approximately 150,000, and propane's market share has fallen from 5% to 4.7%. As the brown line shows, domestic consumption has been on the decline. Simultaneously, production has increased by almost 80%. As a result, the share of propane delivered to the domestic market, the blue line, has fallen from nearly 100% to about 50%. As a result, increasing volumes of propane are finding their way onto the export market. This slide is a slightly different way of looking at just how much of an impact rising production and declining domestic demand have had on propane supply. Since the 2013-14 winter, product supplied, our proxy for domestic consumption, has not once exceeded propane production. The United States now produces enough propane in any given month to satisfy all domestic demand for even the coldest months of the year. The difference between that demand and production must be met with changes in storage levels as well as exports. And while over the course of the past 7 years or so we have seen storage levels fluctuate, it is the exports that are now acting as the main relief valve for this surplus in production. Exports, in turn, have facilitated the reintegration of the U.S. into the global propane market, which is reflected in prices. The chart on the left shows how, after the U.S. became a net exporter, but before export terminal capacity caught up with demand, domestic propane prices decoupled, meaning disconnected from their historical relationship to crude oil. Discounting on the U.S. market was a reflection of surplus supply pricing itself to clear, whether as an economic petrochemical feedstock or as an alternative fuel where fuel switching was an option. Domestic propane prices fell not only relative to the prices of other petroleum products, which are generally priced against crude oil, but against propane prices overseas. The chart on the right shows the very close relationship between propane prices in various international markets, including Europe, the Far East, and the Persian Gulf, another major source of propane supply to the international market. What is telling, whether looking at the chart on the left or the chart on the right, is that when the U.S. was a net importer of propane, U.S. prices generally followed crude oil prices, and, switching focus to the right-hand chart, U.S. prices also followed international propane prices. The period between 2012 and 2016 was in essence an anomaly. Domestic production was rising, domestic demand was flat or falling, and inventory levels were rising to unprecedented levels. Once export terminal capacity caught up to the surplus and allowed the market to clear, U.S. and international prices again returned to their historical relationship. This is what we should expect going forward. So how has infrastructure changed to accommodate the growth in production and changing demand dynamics? As increasing volumes of propane move to the Gulf Coast, whether as purity products, the black lines, or as Y-grade, the blue lines, the market has come to rely on rail for more of the delivered volumes. This is true whether we look at the Midwest, or the upper Midwest, where propane imports from Canada now come by rail rather than by the Cochin pipeline, or when looking at the Northeast, where rising production is being accommodated by rail shipments out of the producing region due to lack of sufficient pipeline capacity, or even on the Gulf Coast, where propane is now being delivered by rail from as far away as Canada and shipped by rail for exports to Mexico. While rail is certainly flexible and responsive to changing market conditions, it does not provide the steady flow and direct access to supply that pipelines do. And during severe weather, there may be challenges in moving the volumes necessary to satisfy demand, whether due to congestion on the rails, speed restrictions, or other factors. Another reflection of the changing geography of production and demand has been, as mentioned before, the repurposing of import terminals to allow for exports and the addition of export capacity. Both the Marcus Hook terminal in Pennsylvania and the Chesapeake terminal in Virginia now serve primarily as export terminals for hydrocarbon gas liquids, including propane. Of the 3 terminals that allowed for imports of propane into New England, only one remains at Newington, New Hampshire. New pipeline capacity, on the other hand, has been focused primarily toward serving growing demand on the Gulf Coast for both petrochemical feedstock and exports. One thing you will hear from investor presentations by pipeline operators is how much they have been able to reduce the seasonality of their assets through these changes. The challenge during the winter months, therefore, is to have product available close to the consumer. This can be accomplished either through booking of firm capacity on pipelines and at storage caverns, or by building stocks in retailer tanks, or ideally in consumer tanks as part of a summer pre-fill program. One aspect of the market that often goes overlooked is the role of Canadian propane in the U.S. market, especially during the heating season. With relatively low demand and significant storage capacity, Canada, and especially Western Canada, serves as a significant source of propane supply for the Midwest and the Northeast. Even in the absence of the Cochin pipeline, large volumes of propane get stored either near Edmonton, Alberta, or near Sarnia, Ontario. Coming into this winter, in fact, propane inventories in Western Canada were at all-time highs, while inventories in Eastern Canada were well above the 5-year average. And when temperatures drop in the U.S., that propane gets moving, actually mostly rolling. Now that there is no pipeline linking Western Canadian supply to Midwestern demand, rail has stepped into the void. Since early last year, we have been publishing rail movements of hydrocarbon gas liquids by rail, a result of our data sharing agreement with the Surface Transportation Board, and this data goes back to January 2010. What you can see in this chart is that when the Cochin pipeline was removed from propane service in 2014, shipments of propane by rail into the Midwest, PAT 2, rose and have remained high ever since. Shipments of propane by rail from Canada to the East Coast, PAT 1, have also become more seasonal. This is a reflection of increasing production of propane coming from within the region, primarily Western Pennsylvania and West Virginia. It is for these reasons that when looking at supply into the propane-consuming regions of the Midwest and Northeast, it is difficult to draw a full picture without looking at factors other than inventory levels, especially when those stocks are overwhelmingly dominated by storage facilities on the Gulf Coast. A full picture only emerges when looking at other aspects of the market, such as the pricing relationship between the U.S. and the international market, the relationship between prices at Conway, Kansas and Edmonton, Alberta, at the infrastructure and its ability to both take away and deliver propane to and from the various producing and demand regions, and at inventory levels on a more regional basis. EIA has over the past 3 years been reporting PAT 2 inventories for 4 select states, groupings of states in the weekly propane market update. We also include, when available, updated inventories of propane in Canada, the price curves for propane spot prices at Mont Belvieu, Texas, Conway, Kansas, and again, when relevant, price curves for propane in Edmonton, Alberta. This is in addition to the weekly reporting of inventory levels of propane for PADs 1, 2, 3, and 4 and 5 combined, and delivered propane prices for 38 states that come out of EIA's SHOP, State Heating Oil and Propane Program. Thank you. We will now move to the Q&A session of this webinar.